Okay, I think the T-shirt says it all. Jay hold us again like he did in September, and I don't really blame him. I'm not one of those, resource newsletter writers who thinks he's the devil incarnate and the Fed should be killed and all that kind of stuff. I don't have a big problem with the Fed, and I actually think Powell's a good Fed chairman. He's very much in an untenable position. He's trying to figure out how to get his way out from this without blowing everything up. But I decided to start with this slide, and yes, I did the T-shirt online just to get that point across, because I will be saying some positive things, and there's a lot of positive stuff going on today, and it's not entirely clear why, but we're not going to look a gift horse in the mouth, obviously. But understand that it's probably going to take a fair amount of movement in several macro variables before Powell really changes. I'd be very careful about taking Wall Street's pivot talk too seriously. They've been premature in this all year long. Basically since Q1 this year, I've been telling subscribers, like, the only way I see to deal with this, the only base case that makes sense to me is to take the guy at his word. I'm not assuming he's lying when he says he's going to do this or that or the other thing. And he's pretty much said exactly, he's done what he said he was going to do for the whole year. So at this point, I see no reason to assume he's suddenly not going to do what he says he's going to do. So I'm just going to take him at his word and try to use that, as the guide to what I think the market will do and how to deal with the market. Wall Street's always going to put the most bullish spin on it. I mean, that's fine. That's what Wall Street does. No problem. But I think you could tell if you watched his Q&A a couple of days ago, you could tell how sort of irritated he was getting, and I kind of don't blame him. Everybody's laser focused on these, when he's going to go from 75 to 50 basis points, because that's the pivot. Well, that's not the pivot. The pivot is when he goes from raising rates to lowering rates. That's the pivot. I think we should all keep in mind that Wall Street seems determined to treat a step down as a pivot, which means they will trade it accordingly. So it may well be a tradable event. Part of today's chatter is that today's job report is a Goldilocks NFP. I don't see it when I look at it, honestly, because they beat by about 100,000 jobs, and the month-over-month wage gain came in at 0.4 instead of 0.3. So that doesn't sound like Goldilocks to me. But Wall Street's decided that's their story, and we're sticking to it. So fine, and that's something to keep in mind going forward. Even though you would think you won't see the move in, say, gold and silver until the first rate cut, it will definitely be ahead of that. The market always is ahead of this stuff. It will be when the market decides 100% he's not going to raise rates anymore, and that could be 3 or 4 months before he actually stops raising rates. Once the market is totally all in on the belief that we know where he's going to stop and it's going to be soon, that's probably when we really start seeing sustained moves out of gold, silver, metals, and quite possibly the S&P as well. I mean, the market discounts this stuff ahead of time. So, I'm not saying we wait until the last second. Now, the one thing that, the one thing we don't know is how hard he's going to push, how much damage is he going to do. I mean, he's talking about holding the terminal rate for a long time, like a year plus, which I'm a little bearish and I'm skeptical about that, honestly. I think something would blow up well before that. It is important to keep in mind that the way he talked Wednesday, the terminal rate now is probably, 5.25, 5.5. It could be higher. One thing to keep in mind is that so far he simply hasn't gotten his way. And if these two charts you see here, the one on the left is a 2-year, one on the right is a 10-year. You can see how much those have moved this year, especially the 2-year, which has gone from under 1%. Today was at 4.7, and that big bar you see on the left, on the right-hand side of the 2-year chart, that's Volcker. That's Powell playing Volcker on Wednesday. And he basically said, I mean, he wasn't being that obtuse. He was saying, look, as far as we can tell, yes, you've got this dot plot from September, and yes, it goes flat at 4.6. Like, that's out the window. It's definitely going to be higher. It's almost certainly going to be higher than 5. I mean, it's not like he isn't saying what he's going to do. And the other thing to keep in mind and to note here is the 10-2, which is one of there's several series of bond curve measurements that they use when they're, and it's basically just a measurement of whether it's inverted or not. Right now, the 10-2, it's inverted by 57 points, which is a lot. That's a big inversion. There were only portions of the yield curve until recently that were inverted. It's pretty much all of it now. And well, I wouldn't be hidebound enough to say inversion equals recession. It is one of the most accurate measurements we've got of an incoming recession. It's not immediate. The recession's usually a quarter or 2 or 3 out. But when you see this kind of an inversion that's sticking, and this one is, yeah, I mean, odds of a recession next year are pretty high. You know, we got to a bottom. I mean, suddenly again today, I mean, it only took 2 days from the last Fed meeting, but suddenly again, people are going, you know, are we at a bottom? I don't think so. I mean, I'd be pretty happy to be wrong about this, but we're still talking about another 150 basis points. If he's going to get to that 5 to 5.25, and it's not out of the question he's going to have to go higher. I didn't see today's NFP report as being Goldilocks at all, but apparently Wall Street kind of sort of did, or at least it didn't dump on it, which is what I thought was going to happen. So great. Maybe a couple of those doesn't change things for him. CPI is obviously huge because inflation is really what this is all about. So next Thursday is the next CPI report. I don't really think it's going to come down a lot, but that is the Goldilocks scenario, is if CPI comes down like 1% or 1.5%. If it does, Wall Street's going up 400 or 500 points in the next 2 or 3 days after that. Wall Street will go nuts. I'm not convinced. I've felt all along inflation was going to tail off very slowly, which is what has barely tailed off at all. PCE hasn't tailed off. It's still going higher, although I think it might actually settle out here. But you know, the Fed keeps reiterating, like, we're not kidding, we want to get it to 2%. That doesn't really seem realistic to me, but again, I got to operate on what they say. If they're bound and determined to get it to 2%, well, rates are definitely going at least 150 basis points higher because it takes time. The other thing that we might get a bit of saving grace from, and this is another thing, I mean, I'm kind of just going through the Wall Street narratives, the recent ones. This has been a really popular one. It's popular one every year. The old seasonality, the Santa Claus rally. I thought this chart was really interesting because what somebody did is they took the full set of annual S&P charts and they broke it down into bull market years and bear market years. So the white line in the middle, that's sort of your average return in an average year for the S&P. And you can see how it slopes up at the end. That's the famous Goldilocks rally. Mostly that's because of an even stronger rally you generally get in bull market years. In a bear market year, and I think we'll all agree this is a bear market year, that seasonality doesn't seem to work very well. So, you know, I'm not saying everybody be super bearish. I'm just saying be pretty skeptical about the Santa Claus rally argument because you're going to hear a lot about that in the next 2 or 3 weeks. The other thing, and the other reason why I don't think we're at a bottom is sentiment. I'm not big on trading sentiment. I mean, it's a bit, you know, it's always been a bit iffy for me because it's pretty useless for timing. I mean, sentiment is useful for sort of taking the temperature of the market, but it's not something you can generally use as a timing guide. It just doesn't really work for that. But I got to say, when this thing on the left, this is a survey that gets done by the American Association of Individual Investors, so retail investors, basically, big group. It's a big sample. They do this every week with their members, and it's a pretty widely followed survey. And I was honestly pretty shocked. What you see here, because the higher you are, the more recent it is. People were getting more and more and more bullish through the last month, and significantly less bearish through the last month. That shocked me, to be honest. I was just like, "What the hell?" Okay, apparently I'm looking at the wrong stuff. But my point is, it's not that you can take that to the bank, but when you see surveys like that, that's not what a bottom looks like. If it was a bottom, it would be like 90% bearish, get me the fuck out of here. I hate stocks. I'm going to go shoot my broker. I mean, that's a bottom. You know, pretty much straight even between bullish and bearish. That's not generally what big bottoms, that's not what they look like, unfortunately. And the one on the right side, this is one that's commonly used on the street. This is the VIX. The VIX is just, it's a volatility index. It's called the fear index on Wall Street. I think the fear part of it is overdone, but there's no two ways about it. One common trait of bottoms, especially major ones, is a significant increase in volatility. So I mean, you look at 2020, COVID, it went all the way past 80. This was when things went into an almost bear market. That was the last time that Jay flipped on raising rates. I think this one's Volmageddon, which was actually a really convoluted short-term blow-up in this specific market. But look at where the VIX is right now. It's kind of middle of the road for this 10-year series, and it's middle to lower part. And normally, if you're getting close to a major bottom, this is going to start to really climb. So again, it just doesn't look like a bottom. I'd be happy to be wrong about this, and if the market go up from here, it would make my portfolio look a lot better. But I'm just calling it like I see it, and what I'm seeing so far does not look like a bottom to me. I think we got more to go. There's been a lot of talk about how the one thing that would make this happen, of course, would be inflation really coming off fast. Maybe it does, but I think it's worth looking at this chart on this. I mean, this chart on the right always amuses me. What this is these are the actual core, the blue's core, the green is headline U.S. CPI, Consumer Price Index. These dotted lines, those are Wall Street's projections of what inflation would do. You can see they've been wrong again and again and again and again and again and again. They always expect it to dive. So far it hasn't. Who knows? Maybe next month will be the month that it happens. I ran out of room and I didn't want to spend too much time on this, but there's another chart I probably should have thrown in here, and it's basically an overlay of all the inflation spikes over the last 60 or 70 years, and basically what inflation does coming out of those. And it declines, but it's a fairly flat decline. It doesn't happen fast. It goes back to the previous CPI level over like 2 or 3 years. And if you look at the current projections of Wall Street stuck onto the middle of that, they just almost go straight down. Does it happen? Maybe. But part of the reason why I don't think it's going to happen is the chart on the right. As I'm sure you all recall, coming out of COVID, we had this big move in inflation, and the scenario and the talk all the way through, especially 21, and we really didn't tail off until we started getting into 22, was this is all supply side. In other words, it's transitory. It's going to back off as soon as we get through this supply shock and that supply shock. What this chart shows is this group broke this down into supply factors and demand factors. And you can see, definitely coming out of COVID, you get to the point where it's predominantly supply issues. That's what created the inflation. But you can see as we go through into and through 22, supply is a smaller and smaller part of the problem. I mean, most of the supply problems are gone. It's now a demand issue. That's not a good thing in terms of what Powell has to do if you're the Fed. What this chart means, if that doesn't fall off organically, is the way to bring that down is demand destruction, and demand destruction means raising rates till something breaks. That's what you do. That's not what any of us want, but that's what you would do. So I mean, it's kind of interesting. I mean, I threw these charts in this morning actually because today was insane. And I'm not entirely sure why, although I've got a couple of guesses. But normally we see you see these rates rising all the time. That's going to mean stronger and stronger greenback, which it has for most of the year. That doesn't do metals any favors. It definitely doesn't do gold and silver any favor. Although everyone I talk to in the gold space tells me physical demand is extremely high. There's a lot of stuff I'm not somebody that buys a lot of bullion, but apparently it's quite difficult to get most forms of bullion. It's all been impossible to get most of the good coins right now. Imports into China have been good all year long, but they've been probably central bank, because they aren't buying jewelry and stuff, they're buying bars. And as you probably all saw, this has actually been a massive buying year for central banks. Central banks have already exceeded, I think, every year in the last 25, and that was up to September 30th. So apparently they all thought it was a good idea. I was, after the press conference, the FOMC conference on Wednesday, I honestly was pretty skeptical that this 1620 would hold, and I said as much yesterday. So of course gold naturally turned around as soon as I sent that out, just to make me look as dumb as possible. But gold has had a big move here, and part of that is because there's been a really big dump in the US dollar today. Some of that ironically is us, and I mean the collective us, because Canada had a huge beat on its payrolls this month. It was supposed to be 10,000 jobs out, it was 110,000. So that's got people thinking, oh, well, the Bank of Canada is going to have to they're going to have to crank rates higher than we thought they would. So the Canadian dollar is up about 1.5 cents. That's part of the reason why the US is up almost 2 cents. It's big enough that it looks like maybe there's some central bank stuff going on, but I haven't been able to find anything this morning. Thought, maybe it's Bank of Japan, maybe it's ECB, maybe somebody's messing around in the currency market for their own reasons, but for whatever reason, I mean, who cares? I'm not going to look a gift horse in the mouth. As I'm sure most of you are probably aware, the gold price is actually up around here someplace right now. It's up around 1680. I'm not a technical analyst. I'm not a chart guy. Chart guys that I know tell me 1675 is important. That's one of those levels. They said, look, if it gets through that, it's probably going to go further because there's probably a whole bunch of stop losses and stuff set there. So if it manages to get through that, you may actually see it move a bit. The one that's really insane today is copper. This one, I think I know the reason. I don't know if it's valid yet. There were rumors about a week ago about China opening up and stopping the COVID-0 policy. Those got quashed. Then they came back again last night. A couple of Chinese guys on my Twitter stream who seem to be well connected. They're saying there's a meeting starting today with a whole bunch of the provincial guys and 2 or 3 of the top Politburo guys and Z too, apparently, presumably. They're not saying yes, zero COVID's over. They're saying, as far as we're hearing, that's what the meeting's about. They're just saying, like, we're not second guessing whether they're actually going to end it, but they're talking about ending it, and that's why copper's going. That plus the US dollar isn't hurting either, obviously, but that's why copper's up 20 cents today. And that tells you a lot. And I mean, going forward, today gives me a little bit more comfort on the gold and silver side. I mean, I'm still, I'd really like to hope that 1620 is the bottom. But like I said, I mean, I think the Fed's doing another 1.5% and potentially more. If that's the case, then I wouldn't be surprised to see gold break 1620. I don't think it goes a lot lower, but I'm a little more concerned about that. I don't think there's a huge amount of downside in base metals. There only will be if the Fed pushes so hard that they create a really, really bad recession, which isn't really my base case. I think they're going to push until something breaks, which creates a recession, but not necessarily a deep recession, just a mild one. I don't know that would cut demand enough to have a really big negative impact on base metals. The fact copper moved like that today gives you a pretty good indication of how tight that market is, and most of the base metal markets are. It doesn't appear to be hidden inventory. China has been importing all year, and their economy is a mess. In the past, it was a lot harder to tell what China was doing because there were a lot of hidden inventories, and what they were was guys that had imported copper that they knew they could sell internally later, and they were using that as collateral for bank loans for property and stuff like that. So the copper wasn't, it was there, but it wasn't really available until they cleared the loan. But apparently, Beijing has really cracked down on that. So those hidden inventories are apparently not around anymore because basically they can't use it as collateral anymore. The orders came from on high. Don't let these guys do this anymore. So there don't appear to be hidden inventories. Things are tight across all the base metal markets, so I'm still very comfortable with base metals. We just might get a dip if there's a real recession. Gold and silver, it should move first. 2008, 2009, gold moved 4 or 5 months before, gold bottom 4 or 5 months before Wall Street did. And I would expect something similar here. And, cross our fingers, cross our hearts, maybe that was today. Maybe that was the bottom, because it's not, I don't see a logical reason to remove that strong, but I'm pretty encouraged by the fact it bounced in the same place. We basically got a double bottom, and it's coming off this one really hard. So, I don't want to get too positive, but I took that as a good sign. So, I mean, bottom line, I don't yet believe that what we just went through was in early October was the bottom for Wall Street. I still think there's probably one more leg down. Really, it's all about inflation. We're all going to have to watch CPI and PCE reports over the next few months, and obviously payrolls, because that's what hasn't worked for the Fed, pure and simple. He wants to see either very small payroll gains, or ideally, I mean, he's not an ogre, but just in terms of his model, he would prefer to see job losses, and he definitely wants to see inflation come down. And I'm still where I was all along. Don't assume he's going to blink. Everybody on Wall Street, everybody wants to be bullish on this or the other thing, is assuming he's going to blink. He hasn't yet, and I'm not assuming he will. So we're probably going to see a bunch more of that. All of that said, I think things are starting to stabilize. I think we're probably going to have 2 or 3 or 4% inflation for a long time, and the market will just adjust to that. It has before. I mean, we've gone through long periods of inflation at that level, and it's not the end of the world. But the market, everything in the market has to adjust to it. The good news is, in that kind of environment, really one of the best places to be is commodities and metals. So I'm not offended by the idea that may be the long term. And as long as you're dealing with companies that are good value, guys that have lots of cash, and/or guys that have, exploration programs where it's got the potential to really move the needle if they get good results. And that's basically the companies I've invited are sort of epitomes of that.